Okay. Is this on? Not yet. Should be on. Yeah, now, okay. Lovely. Good afternoon. Thank you for coming to Bruegel. Very pleased you're here. So we have an afternoon of discussion on risk and complexity in banks' business models and banks' assets. Now, this may strike you as a technical subject, but maybe some of you owned at some point in your lives, in your investment portfolios, a CDO squared or a CDO cubed, and you're dying to know how your investment manager valued this and explained the risks to you, or may not have done so. Of course, we are in a different phase now of risk reduction and simplification, and I'm very pleased we have this panel here to discuss how far this has progressed and how risky bank balance sheets really still are. So before introducing the panel, let me just motivate the discussion maybe with a few ideas. Financial innovation is, of course, something that was the mainstay of the industry, and the complexity is, of course, the result of ever more resources going into the design of new products. So whereas previously perhaps the idea was to complete markets, to open up new opportunities for risk diversification, these days the regulatory effort and perhaps also banks' own business strategies are going the other way. Adair Turner, at one point the head of the Financial Supervisory Authority in the UK, pointed to many products being socially useless. So the question is, have we gone far enough in rooting out the socially useless while preserving the vibrance and dynamism and innovation in the financial industry that we need for risk-based financing? So that is the context. So I'm extremely pleased that we have a panel of experts here. We will begin with the paper by the Bank of Italy. Paolo Angelini is the director of the Monetary Affairs Division in the Bank of Italy, and one of the co-authors, Mr. Potente, is in the audience and will back him up. We will kick off with you, and then we will have comments from various perspectives of policy and the industry, starting with Martin Merlin, Director at DG FISMA. Thank you very much for joining us here. And following on with Jusina Kamerling from the CFA Institute, and Simon from Moody's, bringing the perspective not just the debt investors but also the equity valuation of these assets, and then of course our very own Nicolas Véron with a perspective on the broader context in risk reduction in the European financial markets. So with this, let me hand over to Paolo and the presentation.
Thanks a lot, Alexander. I think I have the mic on my tie. And so first of all, let me thank you and Bruegel for having us here and giving us the opportunity to present this paper. The paper, for those of you who have seen it, is very technical. I have tried together with Francesco Potente, one of the co-authors, to reduce its size to a manageable version with these slides, but given the limited time available, I hope I had 20 minutes, and then now I learn it's 15. I'll probably skip some of the slides. So without further ado, let me go to the presentation. The idea here is to give you an overview of these L2 and L3 animals. What are they, and what size are we talking about in terms of numbers in banks' balance sheets. Then focus on issues relating to the discretion that is allowed to banks and financial intermediaries by the regulatory framework and the incentives that intermediaries may have in using this discretion to their advantage. Then there is an attempt, a very synthetic attempt in the slides relative to what is in the paper, to gauge the riskiness, the tail risk of these instruments. We go by clues, not really by proofs. There is no smoking gun in this paper, and the bottom line indeed is we do not know much about these assets, these instruments, and possibly we need to learn more. There is no really proof of any sort that there is a problem in this environment. Then some conclusions. So what are L2 and L3 instruments? The accounting rules define L2 and L3 by defining what they are not. So basically, accounting rules define L1, level 1 instruments based on the fact that they are traded in active markets. Whatever is not traded in active markets can be labeled as L2 and L3. L3 are those instruments that are more complex and more opaque relative to L2. So there is a hierarchy of these instruments. The valuation of L3 instruments normally requires assumptions and on unobservable components and sometimes models. So in some cases, the L3 especially can be not just simple plain vanilla instruments, but a combination of instruments. And therefore, their degree of complexity is high. And due to these features, some of L2 and most of L3 instruments can be described, as the slide says, as complex, opaque, subject to relatively high valuation uncertainty, and therefore normally illiquid. This is a first fact that we extract from the papers, some figures on the incidence of these assets on the balance sheet of SSM banks. You find on the left-hand side column total assets or liabilities of SSM banks. So the total is about 22 trillion. These data pertain to December 16. The fair value of these assets is about one-third, 6.7 trillion. L2 assets are about 3.4 trillion, and L3 assets are much smaller, as you see, less than 1/10 of L2 assets at about 190 billion. So the total of L2 and L3, if you sum assets and liabilities, boils down to 6.8 trillion as of December 2016. There is one reason that I'll go into during my talk, why one may want to sum assets and liabilities, something that we do not normally consider. So the second fact is that there is not much information on L2 and L3. There are no ready available data on risk drivers, on returns. There is no breakdown between complex L2 versus plain vanilla L2. This is an issue that we heavily discussed with my colleagues in drafting the paper. You've seen from the previous slides that L2 are a huge amount. Most of the stuff is there. And indeed, a large portion of these assets are sort of plain vanilla type of thing, although they are not quoted in active markets. And then there is another portion of undetected, undetermined size that is probably more similar to the L3 type than to the L2. So there are other issues that are listed on the slide. The paper goes to some length in arguing this. There is also very, very little literature, academic and non-academic literature on these assets. The paper has a small survey, probably non-exhaustive, but it does point to the fact that much of the interest was created in the aftermath of the Lehman default, and then and later on there wasn't really much academic or policy-related literature on these issues. So these are facts. Then there is this long section in the paper and in the slide devoted to these two things. On the one hand, we argue that there is discretion allowed to the intermediaries in interpreting prudential and accounting rules. On the other hand, there is, as usual, an incentive for intermediaries to exploit this discretion. I could really skip the following slides. I'll go through some of the key ones, but these are well-known facts. These are not really specific to L2 and L3. I mean, the entire regulation of financial intermediaries is rift with phenomena of this sort. There is some discretion, and of course, whenever there is discretion, think about modeling, IRB models, etc. Then you have, of course, an incentive for an intermediary to exploit this discretion. So we need a few definitions in order to go ahead. Under IFRS, a fair value is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants. IFRS also established the hierarchy that I was telling you about, and it is based not really on assets but on input used in order to price, to give a fair value to those assets. Some inputs are observed in active markets, as I was saying before. They are normally prices, and whenever there is no active markets, then you go to the level 2 inputs or to the level 3 inputs. The level 3 inputs, as you see, are based typically on unobservable input. What do I mean by unobservable input? For instance, some of the instruments may require a volatility or a correlation, and sometimes it is possible to compute a correlation at certain maturities, but then as you extend the maturity beyond a certain limit, you no longer can observe data to compute a correlation, and therefore you have to extrapolate or to infer a correlation based on alternative instruments. Whenever unobservable inputs play a significant role, the instrument should be assigned to the most conservative classification. So that is a prudential type of provision set out in the IFRS regulation. So the wording that was in red in the previous slide are taken up here because each of these specific wording embeds some degree of discretion and or incentive. So orderly transaction, that means that IFRS rule out an evaluation based on distress, a concept of distress, basically. Whenever you use fair value, you rule out a liquidation type of approach. It has to be a transaction between willing parties. Since some of these assets and instruments are very liquid and very bespoke, sometimes banks and intermediaries, in order to come up with this fair value, need to sort of simulate a market. Because de facto, the only way to do away with one of these products would be to undo the transaction with the same counterparty that the transaction was entered into. So de facto, what in principle should be a fair value based on an orderly transaction can be something far from orderly in case the assets need to be unwound. And of course, this introduces discretionality in the valuation process, and whenever there is discretionality, there is an incentive to bias the valuation one way or another. Also, active markets. Recall that active markets is the borderline, sets the borderline between L2 and the other assets in the hierarchy. And the IFRS explicitly state that the active market has to be inferred based on standard indicators such as volume of transaction, frequency of transactions, etc. But there is no magic number to state whether the market is indeed active or not. Think, for instance, of the swap market. That is probably the most liquid market in the world. people in the insurance sector are debating whether the 30-year maturity should be considered liquid or not. It's clear that liquidity is present up until 20 years. Beyond 20 years maturity, things become discretionary. And of course, this also introduces discretion for banks and intermediaries, and again, incentive to use this discretion. This also has to do with observable versus unobservable input. Remember that the observability marks the difference between L2 and L3. If I have a market that is borderline active, I may have a borderline observability. There is again a margin of discretion on this front. And what about the incentive? The incentives are to bias the observability toward actual observability rather than unobservability. Why? Because everybody in the market is pretty much aware of the fact that L3 instruments carry a stigma effect. They are perceived to be risky. Indicators such as L3 over total assets or L3 over CET1 are monitored by rating agencies, by market operators. So an intermediary that has the option to classify an instrument as L3 or L2 maybe has an incentive to classify it as L2. The same goes for significance of unobservable input. One of the tricks in the regulation, in the accounting regulation, is that if you have an unobservable input, for instance, a calibrated correlation entering the valuation of an instrument, you should be classifying it as L3. However, if the contribution of this unobservable input to the fair value is not significant, then you are allowed to classify it as L2. And of course, the degree of significance is not explicitly stated by IFRS. It is a matter of assessment. And again, banks have incentives to bring the input into the insignificant status so as to be able to classify an asset as L2 rather than L3. The slide here reports a limited piece of empirical evidence supporting the heterogeneity of behaviors on this front. The study quoted by the paper reports that the same instrument at the same time is classified by different operators in the same category only 40% of the time. So an issue is clearly there. Since I promised I would skip some, let me go to this day one profit mechanism. That is something I ran into a while ago and again by reading and helping the authors of this paper draft the paper. This day one profit mechanism is quite interesting. It's described in detail in the paper. Basically, it is based on the fact that the price recorded on a transaction need not always be the fair value of the object. So I may basically buy an object, say a derivative contract, and pay some money for this object, and then book it at fair value at a different value. This can happen, for instance, if I have an informational advantage, or if I am a market maker and I know that I can buy something with a virtual certainty to resell it at a higher price. So in this case, accounting rules explicitly allow and indeed mandate to the intermediary to book the asset at a price that is different from the value that is different from the price, even though the price is recorded in an active market. So that can give rise to so-called day one profit. The bank can post a profit on the same day of the transaction. And this thing seems like a curiosum, right? That there shouldn't be much going on this front unless there is inefficiency or irrationality in the market. It turns out we do not have solid data on this, but it turns out that in some cases these day one profits make the bulk of some of the trading desk at some intermediaries. So this is really something that would elicit further scrutiny. Another important thing, and I'll close here for the discretion and incentive part, is the issue of netting. You have seen that these instruments loom large in banks' balance sheet, but that large assets are ordinarily matched by large liabilities, so that if you consider the net amount, even at the single bank level, not only at the aggregate level, you come up with much smaller numbers. And these, of course, makes perfect sense, because most of the times the issue is that the bank or an intermediary will have an asset that is hedged by corresponding liabilities or set of liabilities, so that in practice the risk is substantially reduced. At the same time, this thing can create space and room for discretion, and also to overlook the so-called basis risk, which always arises when the hedge is not perfect, when it is not really perfectly, when an asset is not perfectly matched by a liability. So, 5 minutes? I'm getting there. So. So this is all, I think nice to read and to learn. Again, this issue of incentives, as I said, is not really new to this, not specific to this environment. It can be found all over the financial intermediation world. So in the large section of the paper, we try to put together clues about things, about risks, about what might possibly be under the hood of this world. This chart reports one possible clue, and it represents the so-called AVAs, the additional valuation adjustments, for a sample of 18 banks working in the SSM. And those are the banks where much of these L2 and L3 assets and liabilities are concentrated. You see the number of banks on the horizontal axis. The vertical axis reports basis points, because the measures, the blue and the red bars, reports indicators of extent, weight of these AVAs over L2 or plus L3. And those are the blue bars, or AVAs in terms of CET1 ratio, basis points of CET1, how much do they account for? So what are these AVAs? The AVAs, to put it shortly, are the valuation, as the name says, valuation adjustments that are computed as follows. The bank or the intermediary is required to compute a fair value, and that is given by the various mechanisms and formulas whenever as required. And then they are also required by the prudential regulator to compute the so-called prudent valuation. The prudent valuation is an alternative concept to fair value, and you can think of it as a stressed version, basically. You take the fair value and then you stress it so as to get something prudent. Then you subtract the former from the latter and you get the AVA. It is basically some sort of a, again, the result of a stress test. So the prudential regulation tells the intermediaries that this stress test result must be deducted from CET1. Again, as a matter of prudence. So the message emerging from these slides is that these prudential adjustments altogether do not seem large, either in relation to L2 and L3 altogether, or in relation to RWA. In practice, as you see, there is a lot of variation across banks, but on average, the red dashed line tells you that these AVAs are on average 20 basis points of CET1. If you consider that CET1 for European banks is, I don't know exactly, but in the ballpark of 13%, 20 basis points relating to 3-something billion of assets or liabilities is really isn't much. Another large section of the paper is devoted to this risk profile of L2 and L3. There are, again, various possible clues of what the risks might be. The objective of this section is to answer the question of whether valuation risks for L2 and L3 is sizable. And the answer, in short, is we do not know really. So we have clues, but no clear answers. Why? Because there are not many data on this issue. So one exercise that you find in the paper is the following. What do we do? What happens if I shock the value of L2 plus L3 asset by 5%? What happens to capital, other things equal? So this is a crude sensitivity exercise that tells you that a 5% shock to assets would trigger a fall on average by 330 basis points of CET1. And the range is between 70 and 1,500 basis points. So a lot of stuff. Another exercise which we attempt in the paper is based on simple stock returns, not averaged, but computed over the 2008-2016 period. And the three belts that you see in the chart are plain distributions of stock returns for three categories of banks. The yellow bell pertains to the controlled sample. These are listed and actively traded banks. The two fatter tail belts pertain to two sample banks. One, the NPL bell with the blue color is computed using returns of banks characterized by a high NPL ratio. The other one, the red one, is computed with stock returns of banks characterized by a high incidence of L2 and L3 asset. And the message emerging from this picture is that both the high NPL and the high L2 and L3 banks have fatter tails. Look at especially at the left-hand side tails, and are statistically different from the control sample. Conclusions, and I'm finished. So the phenomenon is material. About 6.8 trillion worth of assets and liabilities on SSM Bank's balance sheet. Again, there are reasons, the netting issue, as I mentioned, to focus on the gross amount and to look in particular into L2, the big chunk that has not been thoroughly explored so far. There are issues of discretion, there are issues of incentives. About a risk, we do not know really much. The bottom line is that we see room to further dig and to get more data on the phenomenon in order to learn more. Thank you.
Okay, thanks very much. So
talks about are not prudential models. So just to make clear this issue, the models that are underlined L3 are not validated. So we are talking about no. They are different animals. Just to be clear. Sorry for interrupting.
Right, thank you, and thank you very much to the Banca d'Italia for a paper which we find very, very interesting. We find the qualitative analysis very rich. And this is certainly a useful contribution to the debate that we are having on how to reduce risks within the European banking sector. Now, complex financial instruments measured at fair value play, of course, an important role in the financial system. And therefore, it is key to ensure that the accounting and prudential treatment of these instruments captures their value in an appropriate manner. the accounting standards should lead to sound valuation of complex products in banks' balance sheets, and the prudential framework should sufficiently capture the uncertainty and volatility related to induced valuations. Now, on the coming to the paper, on the accounting side, it properly describes IFRS accounting for financial instruments, but it also makes assertions about banks' behaviors and trading practices, which are not easy to verify from the outside. For example, the possibility that banks exploit IFRS flexibility to either improperly classify financial instruments as level 2 as opposed to level 3, or improperly recognize day one profits on level 2 assets. Now, if you want my opinion, to be frank, I am pretty sure that there are lots of practices of this sort in the market, and the fact that there is only the risk of these practices having a significant magnitude is enough for us to investigate the matter, but we probably need more evidence in order to know exactly what is happening in the market on these fronts. So that's for the accounting side. Now, on the prudential side, as you know, and you mentioned that, we have in EU legislation the so-called prudent valuation mechanism, which we think addresses some of the valuation uncertainties associated to level 2 and level 3 financial instruments via the deduction of the additional valuation adjustments from CET1. Now, what your slide showed was that the resulting deduction from CET1 is relatively small as compared to the size of risk-weighted assets, which are due to level 2 and level 3 instruments. But in our view, it's important to stress that the objective behind the mechanism is to adjust the current fair values of the instruments, not to correct evolutions in the future of the risk-weighted assets. Therefore, we believe that even if there is a small proportion of additional valuation adjustments as compared to RWAs, this is not necessarily a sign that the prudent valuation mechanism is inadequate. Now, more broadly, we agree with your assessment that the fundamental review of the trading book, which is ongoing in the Basel Committee, should help in this area. And it should lead to a better capture of the complex risks of level 2 and level 3 financial instruments, and thus result in higher capital requirements that will be more proportionate to the risks involved. And on that, as you know, the fundamental review of the trading book is being discussed both in the Basel Committee and in the Council and the Parliament. The publication of the Basel Committee consultation on FRTB is imminent. Actually, it may come out as soon as this week. And that should help informing the discussions in Council and Parliament, which we hope will be completed this year. Now, I come to the comparison that your paper makes between level 2, level 3 assets and non-performing loans. Here, we felt maybe that that comparison was slightly more artificial maybe than the rest of the paper. Now, on the one hand, we agree that the valuation uncertainty of these financial instruments share some similarities with the valuation uncertainties of NPLs. Both categories of exposures also suffer from a lack of effective secondary markets, and hence they suffer from illiquidity. So that's a point in common. But there are also significant differences between these two categories of exposures. NPLs are usually not fair valued. and therefore are not exposed to the same volatility risks as level 2 and level 3 financial instruments. And in addition, NPLs are financial instruments with obviously poor credit quality by definition, whereas the categorization of fair value financial instruments in level 2, level 3 is not indicative of their credit quality. Last point, we agree that enhanced supervision, enhanced supervisory actions could address some of the issues related to the valuation uncertainties of these instruments. And actually, we think that this is happening. It is happening in the US, but it is also happening in Europe, since the SSM has been working in this area for a number of years now. I don't know if this is mentioned in your paper, focusing primarily on significant banks whose exposures to these instruments are the highest relative to the size of their total assets. Now, to sum up, as I said, we think this is a very good paper, a very useful contribution. There is a real issue that merits continuous investigation on the side of academics, supervisors and auditors. And as I just said, we believe that this is taking place not only in the US, but also in the EU, in the SSM, and also as part of the EMIR legislation, which requests a more granular reporting on derivatives transactions to trade repositories.
Thanks very much. So maybe let's shift to a perspective from practitioners and the industry, with Justina and then Simon. Justina, would you say these types of complex hard-to-value assets are, are a legacy of the pre-financial crisis era, or is it very much a core part of business models in these large European banks where this type of asset is still being generated and engineered and possibly refined further, so that this will be an ongoing problem, as opposed maybe to NPLs where we have some progress now over the last year?
Thank you very much for that. I think we're still getting the echo, but never mind. It's a very good angle you come in on, because as I was preparing for this panel, I was remembering what I was doing in balance sheet management when I was in a dealing room for one of the major EU banks. And I was remembering sort of the actions we had to take with regards to derivatives positioning, etc. And it really, to my mind, it hasn't changed. And I left banking in 2005, so that's 13 years ago. And I really, to my mind, we still have exactly the same problems, quantified in slightly different ways, and we've had the developments, of course, with IFRS. But I think what you have to realize is that we are now, with IFRS and FASB going slightly different routes, specifically on IFRS 9, we are dealing with global banks. So there is a sort of more in transparency in a way for investors. And from CFA Institute, of course, I will come from the investor perspective, buy-side perspective, which is the angle we usually take. So I think it's interesting work. I liked your paper very much, by the way. I thought it was really interesting on looking at the differences in level 2 and level 3, because to our mind, level 2 is where the sort of mass of instruments will find themselves, which has the added complexity. Because it's going to be so big, it's actually quite difficult for investors to find comparability and to find the true valuation. So I think we're still in the opaqueness, and I don't think we have addressed. I'll be very interested to see how Basel will act with the trading book. But again, we have Basel looking at the trading book and capital requirements in Basel, but we have the accounting. So we have differences. And I think as an investor, this creates a complex environment. I mean, we had 2 reports from a colleague of mine, Vincent Papa, on who's joined EFRAG, by the way, on bank reporting, and he picked up on these. He said, the problem is, of course, for investors is to look at what is not in the balance sheets and to look at the explanations, but the explanations are incredibly complex. And okay, we're addressing it now with NPLs, but are we really addressing it now with IFRS going live and then FASB in 2020? So how are we dealing with these differences? In the lunch break, I also mentioned to Alexander, I said, well, Brexit might also have an impact because Brexit, well, it was the UK who was pushing with IFRS, and does that mean that in the EU, maybe Martin can comment on that, what in Brexit, post-Brexit, we might be facing? And, the interpretations, we're trying to look at a global market. Derivatives is a global market, but at the same time, we're fragmenting, and we're not creating more comparability for investors. So I think what Moody's is doing, one of my colleagues picked up that you're recruiting a specialist who is able to compare between FASB and IFRS bank models. So I find that quite interesting because that is the future, I think, if you can find people who can do that. Because at the moment, it's very difficult to compare. So these points, I think, are really crucial to realize when you think about the investors. And I would just go slightly high level here to give you the perspective. We do these yearly surveys on what institutional investors are looking for. Forget the retail, because that's one step even further. But, what is really important is to get the clear explanation of, when returns are not similar, comparability. That's what investors are looking for, institutional investors, comparability. And are we really getting it? So maybe Moody's can come in on there, because I hope you will. I think, leaving, why do investors leave investment firms? And well, we leave because of underperformance. So this is the main topic. So underperformance, if you don't have a comparability, again, of where you expect bank assets to be, and if you cannot analyze it properly, well, again, you have an issue for investors. We're also looking at, when you look at the valuation in L2 on the markets, well, we all know that MiFID has increased illiquidity in markets, bonds. Let's name a cat in this room, but it's true. So, okay, this may not go on forever, but the illiquidity of markets is an issue going forward. So again, how can we get this clear level playing field for investors? I think that is really important. And I will stop there because I could go on forever, but never mind. Sorry.
Okay, thanks very much. Well, this is a perfect cue for Simon and the work of the rating agencies in bringing about this comparability, not just between European banks, but internationally as well.
Yeah, thank you. and certainly I kind of very much by the last comment of Jacina's about the point about international and global comparability. Moody's is a global rating agency, and our analysis of banks is trying to compare not just US banks with European banks, but also African banks, Asian banks, and differences in accounting standards and regulatory reporting standards on a global basis makes our job and those of investors and equity owners of banks much, much more difficult. So anything that drives both greater disclosure but also greater comparability is clearly a positive thing, and certainly kind of we look forward to what comes out of both Basel, but also hopefully kind of over time greater convergence between FASB and IFRS in particular. I just wanted to kind of, there are 4 points, broad points, and I will characterise them. So apologies if it's a rather high level and inaccurate summary of the paper. But the 4 key things I took away were that banks have choices in how they value assets. The market participants can't really observe those choices. Banks can use those choices to hide risk, and then the result is that kind of those type of assets become illiquid on balance sheet, and as we've heard, potentially have some policy and risk kind of equivalents to non-performing loans that sit on particularly in European banks' balance sheets. In terms of my 4 broad high-level responses to that, firstly, that actually mark-to-market accounting is a very valuable risk management tool, and appropriately done is an effective way of communicating the risks that banks face. That said, the valuation of listed liquid assets is inherently opaque. And investors and risk managers need to adjust for that. And that's not just because of the nature of the reporting, but also the volatility in values of those assets actually makes historical data, whilst a useful starting point, a relatively blunt tool for trying to assess risk. Thirdly, whilst clearly some is sort of the theoretical risk of banks manipulating their reporting to reduce their risks is there, and it's inherent with any kind of risk management framework, any regulatory framework. There is limited evidence that banks actually have effectively done that, and indeed, our view is that banks with high levels of level 2 and particularly level 3 assets going into the crisis have been effectively able to dispose of those assets, unlike maybe some banks in parts of the euro area where NPLs are set on balance sheet. And so therefore that kind of broader comparison is maybe somewhat simplistic, and I think kind of that point's already been made by Martin. Just kind of moving on from that, I think we've already covered that level 2 is a very, very broad kind of category. And actually our view is that probably the vast majority of level 2 assets are much closer to level 1 than they are to level 3. And so the comparison maybe in the paper of taking a 5% kind of stress on level 2 and saying that's a proxy, it's a useful contribution to debate, but I think unfortunately what we do need is this greater kind of degree of disaggregation of reporting to make that a meaningful comparison. Our view is that broadly that most level 2 instruments are likely to be liquid. Things like vanilla interest rate swaps are, as we've heard, kind of clearly very liquid instruments, and in our view across most banks are consistently valued. And it comes back to what, again, the accounting framework is versus the prudential regulatory framework. The accounting framework is trying to look at normal operation. And in normal operation, these assets are liquid. Outside of normal operation, in stress conditions, they are illiquid, but then are a lot of assets on banks' balance sheets, particularly in the banking book, kind of not just non-performing loans, but performing loans, have inherently unobservable valuations ex ante. So we think this risk actually applies to banks broadly, but the accounting framework is doing a reasonable job there. The issue is about how you then deal with stress, because valuations of illiquid instruments are inherently uncertain. There is scope for discretionary decisions which are different from bank to bank, but nevertheless kind of are made in good faith and can be justified. But for us, it's about the hard to value in illiquid conditions that's quite important. And so whilst there's no, we agree with a lot of the points made in the paper around the kind of the setup. The way that we deal with this as a rating agency is we say, well, look, kind of banks that have high levels of exposure to illiquid instruments are inherently riskier banks and harder to model banks. So we model this opacity and complexity risk, or incorporate this opacity and complexity risk directly into the rating. We've got 3 ways of doing it, where you've got large numbers of level 3 assets on the balance sheet. We potentially notch down the rating. Where banks have high levels of market risk in the balance sheet, we cap their asset risk scores, which is an integral part of our rating approach. And we make an opacity and complexity adjustment for banks which have a large exposure to capital markets and the biggest exposure to these type of assets. And the reason we do these relatively blunt adjustments is, as I said, the issue around valuation of assets is not kind of just about what they are at a given point in time. It's more how these banks will behave in stress conditions. And inherently, that level of complexity and lack of liquidity in some of these instruments does mean that kind of you need to take qualitative adjustments at times. And as an investor, need to be aware that that's what happens, that you're not necessarily going to be able to model where values will be in some future state. But just in terms of the impact, and just comparing kind of banks with these type of assets on their balance sheets versus maybe some European banks, we rate most of the large global investment banks, which have got the biggest proportion of these liabilities. And looking at level 3 and level 2 assets, since 2008, level 3 assets have come down from 1 trillion, this group of about 13 largest investment banks, to around 200 billion today. This is US dollars. So they've come down by 80%. Level 2 assets haven't come down by as much, but they've gone from 15 trillion US down to 7 trillion. So the idea that there is a big shift of level 3 assets into level 2, we're not able to pick up. Clearly, the starting point is different in an order of magnitude. But the broad trend is that banks have been able to manage down these portfolios relatively straightforward manner. And GIBs in the EU are now approaching the end of their non-core units. Most are expected to close by the end of this year. Value at risk is a quarter of what it was at the start of the crisis. So this kind of tail risk, unlike some other parts of banks' balance sheets, has been able to be dealt with in kind of over time. So these instruments are able to be disposed of. And our expectation, as I said, in normal time, the level 2 valuations are expected to be close to what market values would actually be, whereas level 3 is very different. There is no meaningful way of an outsider understanding kind of whether they're right or wrong. So kind of just to conclude, I think has already been mentioned, non-performing loans, bad assets are kind of not marked to market. They weigh on balance sheets. They are kind of hinder economic growth, take a lot of management time. We think that is very, very different from level 2 or level 3 assets, which tend to be good performing assets, which add to the bank's profitability. These type of assets are now much safer because we've got kind of central clearing, we've got clearer margining requirements. Banks have changed their business models to very much focus on customer flow business rather than taking proprietary positions. And so kind of we think there's a big difference in order of impact between non-performing loans and these level 2, level 3 assets. In terms of non-performing loans, we believe that capitalisation and provisioning is the key to unlocking that. But broadly, kind of coming back to the overall thrust of the paper, we certainly do need, in order to better understand the level 2 assets issue, kind of much greater transparency between the different types of assets on balance sheets, and potentially be able to disaggregate that group into two separate kind of buckets at least. But the evidence we've got thus far is actually they're not. The impact on banks' operating models are very different in terms of these kind of mark to value assets model to value assets than NPLs.
Okay, thanks very much. So that's quite reassuring then. Maybe we give Nicholas the final opportunity. Maybe my question would be, are you similarly at ease with the sort of view that emerges here from Simon, that regulation has moved European banks in the right direction of rooting out this complexity and the risks inherent in that type of access in financial innovation?
Thank you, and I know Martin has to leave us quite soon, so I'll try to be extremely brief, but I don't think Simon implied that complexity had been rooted out. And to come back to your framing at the beginning, Alex, I think banks in a complex financial system, and thanks God our financial system is complex because our economy is complex and advanced, there will always be complex to value assets. So they're a feature of the system, they're not a bug. You mentioned Adair Turner about social usefulness. I'm not sure he would say that today. I think that was, in a way, a very dated comment on, the all-knowing capacity of regulators to make the difference between good and bad finance. I think he has more nuanced view now, and I certainly would have more nuanced view about, the philosopher-king conception of the financial regulator. So I think we have to accept that market practices involve a lot of complexity. We don't have, the kind of Stone Age financial system to serve our economy. We have a more advanced, more complex, more difficult to value set of instruments, and I view that again as a feature, not a bug. Now, on the paper and the argument, yes, I concur a lot with Simon said. Actually, Simon said most of what I was intending to say, so I'm not going to repeat it. I think the paper is very useful to point to the issues raised by level 2, level 3 assets. It's a good contribution. It's not the first contribution. I think Josina very rightly mentioned the excellent work that the CFA Institute has produced on this, especially Vincent Papa, through a series of papers. I think these should, if I may, have been in your reference list because they're really important contributions from a practitioner's perspective on what complex banks are doing, and Vincent has a very critical eye on this. So it comes from the industry, but it's not complacent observation by the industry. And as you said, Josina, the CFA Institute pretty consistently represents the users, the buy side, in that divide. So I think it's an important contribution. I used to be on a committee of the CFA Institute for disclosure, but I no longer am. So no connections there. And I agree with one point that was made very clearly by Simon, and I think also by Martin, that level 2 and level 3 are really not the same thing. And to me, methodologically, the main feedback I have on the paper is that it doesn't discriminate enough between level 2 and level 3. And you explained a bit why and the fuzzy boundary issue, but I think most level 2 assets are things you can hedge, are things you can sell, and that makes a big difference, again, particularly with NPLs, but also with level 3. Now, being a policy person, I will just say a few things about the policy implications of all this. I think the policy implication, I think we have a certain level of consensus here, so far as I can tell, that different issues are different. So the NPLs issue is a big issue. The level 2, level 3 issue is an issue that requires attention. They're not the same. There is a bit of, I thought, a bit of confusing message in chart 10 of the paper because it shows the same bell curve, but without much analysis of causality and different bank profiles and what should come with that. So I, for one, don't infer from that chart that level 2, level 3 are as risky as NPLs, and I don't think the paper does either, but I think there could be room for confusion there. The accounting standard setting is not really questioned by the paper unless I read it wrongly, and I wouldn't question it either because I think any accounting standard for these kind of assets leaves room for judgment and for modeling and for things like that. So I think as a first order observation, IFRS 9 and the other accounting standards that are involved in this, are basically the worst solution with the exception of all others, right? I mean, it's not an exact science, it's not perfect, but that's, again, inherent in the system. Prudential filters, we can discuss. You had this very interesting chart on AVAs. I have sympathy with Martin's take on it, which is that the filter actually creates an incentive for rigor in the fair value measurement and therefore not necessarily something sinister, but I thought the chart was very thought-provoking, so I think it's one of the big value addeds of the paper. I think, however, where we have most to work in the European context, and I'm not coming to issues of global consistency and global harmonization, including between the US and IFRS land, because we know how difficult it is to move these things. But at a more practical level inside the European Union, I think it's a fact, even so the paper doesn't really enter into the detail of this, that we can do better in terms of consistency of IFRS implementation and enforcement practices. And actually the Commission is moving in that direction in my reading with the ESA's review, the strengthening of instruments of supervisory convergence, especially in the context of ESMA, lays the groundwork, even so it's not accounting enforcement is not a focus of this proposed legislation, which is now being discussed. The ESA's review creates the groundwork for a more authoritative role of ESMA in terms of having more consistency of accounting enforcement practices by national regulators, or even maybe one day direct. I mean, I've been advocating this for more than a decade, so I'm on record, having something like a European, an office of a European chief accountant that would, of course, keep the relationship into different member states, but have a much higher degree of consistency of enforcement practices than we have now, precisely because IFRS leaves so much scope for judgment. And I think we can make progress on this, and we should make progress on this. And the last point, which is in the same vein, is that I think in terms of auditor supervision and audit quality regulation per se, despite the progress we can discuss of the recent legislation that was adopted a couple of years ago on auditing. There is a lot to be done, also in the broader context signaled by the ESA's review, to have more consistent supervision of auditors, also learning from some good aspects of the US experience, not learning from the bad aspects of the US experience, in terms of having more rigorous supervision of the audit market. We know that the audit market is somewhat dysfunctional from a competitive perspective. It's a big four, it's a problem. Nobody knows how to solve that competition problem, but we can, to a certain extent, mitigate this through better supervision. And here, as with IFRS enforcement, I see a huge scope for improvement in the European Union going forward. Again, it's not the main focus of the paper in the policy analysis, but I think the paper should stimulate us to think ahead on how we could do better on these fronts. Thank you again.
Thanks very much, Nicholas. Okay, well, let's open this up to the audience. If you have a few more minutes before you need to go, maybe questions to Mr. Merlin first. And yeah, unless you have an immediate response. Yeah.
No, it's just because a colleague of mine in the US picked up a paper by Barclays Group where they looked at, which was published right now at the beginning of 2018, looking at the impact of IFRS 9. And they said that they immediately saw the jump between December 17 to January 2018, a 58% increase in impairment allowance and provisioning. So that is quite significant as a number. So anyway, that was a complement of information I forgot about. There you go.
Good. Questions from the audience?
Another question for Paolo, for me.
Could you just introduce yourself briefly?
Is it working now? Yes. Okay. Actually, in your presentation, you mentioned the booking of day one profits as a potential problem. And the question, of course, is not whether there is discretion, but whether in the assessment of the financial instruments, but whether this is systematically tilted towards a higher valuation, whether it's misused, basically, the discretion. Now, I was wondering if, let's say, if there is this sort of bias, if profits are systematically overbooked on day one, what you should see over time is that if these assumptions do not realize that there should be on day X a loss. Exactly.
Not necessarily.
And so basically looking at the timeline should disclose whether there is some sort of systematic overvaluation or whether this is not the case. Is that a line that you could basically have a look at in your research?
Not necessarily. Two things. First, and I'll let Francesco chip in case he wants to. We do not have much information about this. So having a time series about day one profits, I don't even have a point on this unless I go to the details of the contractual papers that Christina was mentioning. I haven't done it. I don't think my co-authors have done it. So it is hard. And having this information would be very useful. Indeed, I think the paper presents a fairly exhaustive survey of what you can get about this world without the sweat of your brow, without going into individual contracts or very detailed accounting issues. Concerning your hypothesis, it's indeed suggestive. However, let me give you a counterexample. Suppose that I drive without an insurance, and then I don't hit anybody. By the end of the year, I make no losses, and I just hide the risk. I don't insure against that risk, and therefore I will not have a loss anytime along the road. So an issue here can be of hiding risk, neglected risk. The issue is, how large is it? We don't know. I've heard Nicholas and Simon saying, in my opinion, most of L2 are like L1. Fair. We discussed this a lot in drafting the paper. What should we say about this? Is this 10%, 15%, 50%? Large, medium, small? We didn't know. So we said an unknown, but possibly non-negligible share of L2 may be similar to L3. But the issue is we don't know. I think the bottom line of the paper is this ignorance should be eliminated.
Yeah, and I jump perhaps adding something. It seems to me that is common, the common also feeling of the discussant is that the level 2 class has a low discriminatory power. I mean, in level 2 class can be included instruments similar to level 1, is true. We, based also on supervisory experience, we found some ITRAX index, and that's quoted, and no problem. But we have also some other instruments, more complex, such as, let me mention, skew notes or credit-linked notes based on correlation. And I mean, the problem is if we had the capacity to discriminate between this, section of level 2 star, we could also have the possibility to introduce new ratios, useful also for assessing the risk of an institution. And that's the first contribution. The second one is that in similar manner, we do not have enough information about the one. The one disclosure requirements are, very few. You have, if I'm not wrong, only the disclosure requirement when you relieve the one from L3 whenever the input becomes observable. So you have the possibility to relieve the one. In this case, you have the obligation to disclose the amount of the one. But in other cases, is one of the claim of the paper that we do not have enough information from an off-site perspective.
Okay. Thanks very much. Other questions? Yeah, in the back.
Hi, I'm Barbara Mainieri. I'm a fixed income analyst at Bank Degroof, and I have a question as investor, and it's why I should have been more scared to invest in a bank with NPLs and NPLs which are already provisioned. There are more stricter rules, and be, let's say, more happy to invest in a big name with very low NPLs, but big, let's say, portfolio of L2, L3 asset. Because sometimes I have the impression that we underestimate the problem that level 2 and level 3 asset really are. Because NPLs at the end is something provision. Level 2, level 3 asset is something that can be used to overestimate, let's say, asset, underestimate liabilities, and so overestimate equity. And I would understand, so why I should be more scared about NPLs at level 2 or level 3?
If I can add, so Nicholas raised his hand, but maybe Simon or Justina may want to come in. The issues around Deutsche Bank surely should be mentioned. Is that an example of an L3, L2 business model gone wrong, or is this just the market not functioning properly in thinking through the true value of the bank?
Yeah, and I think it really is that point that you can't draw broad brush conclusions and say I'd rather invest in a bank with capital market activity versus one with kind of doing normal lending and taking deposits and lending. Yeah, there are an awful lot of banks in Europe out there which do lending, and they've got relatively small levels of non-performing loans. They're very well provisioned, and our ratings reflect that. And we have those kind of banks in the Nordics where you've got our standalone baseline credit assessment, which is our measure of standalone kind of financial strength, is in our kind of single A category, whereas Deutsche, as has been alluded to, is down at BA1, and that's because of their exposure to financial markets and our view of how well they've managed those exposures. But not all banks within that space are equal. And so if you compare, say, Deutsche in Europe versus Goldman in the US, you've got quite a big difference in their ability to effectively manage their risk position. That said, we don't believe banks with large capital market activity are ever going to be as risk-free as a very well-run bank with low NPLs. The issue we have with banks with large volumes of NPLs on their balance sheet is that I think there are still question marks around the level of provisioning and the degree of capitalization of those banks. And kind of what we've seen is the banks in certain, particularly a number of jurisdictions, the difficulty they've had in disposing those assets, and that's principally been driven, in our opinion, by the amount of capital that banks are holding and their inability to book a loss. So I think that's, for us, it's not about the central case. Central case is lending is a safer business, but kind of the degree of risk from NPLs is different from that of capital market activity.
I have still the impression that at the end NPLs are the view on NPLs is worse than the view on level 2 or level 3 asset yet. Okay. When doing analysis and also reading,
Can we pass this on to the other panelists?
Yeah, no, I think the reason for that, again, I have too much convergence with Simon for this to be interesting. But the reason is, put simply, is that L2 and L3 assets inherently are performing assets, while NPLs are non-performing assets. And that's a big difference. You cannot treat them the same way. So I think it would be an exaggeration to say that the issues about valuation and measurement on Deutsche Bank's balance sheet have completely escaped the attention of the marketplace. I think there has been a lot of market attention on Deutsche Bank, at least so far as I can say. Now, I'm not going to go into much detail on Deutsche Bank, not just because it's a Bruegel sponsor, but also because I haven't done my homework on this. But I think, it's a bank that has been under a lot of spotlight over the last 2-3 years. Conversely, I took from your question that you were assuming that provisions on NPLs were sufficient, and we've seen time and again that this was not the case on a number of banks in the Eurozone. So if we had a guarantee from, somewhere that the provisions are sufficient and NPLs are fine, they're actually very well favorably treated when provisioned in the supervisory framework. But I think the issue is really about the level of provisioning, which again, as Simon said, goes to the question of whether the banks has enough capital to provision as much as they should.
Okay, so both of you just wanted to come in on that.
I don't need, do I? No, I have I think I need it now. Okay. So I think what is an added issue in this debate is that lending banks, yes, we have the NPL portfolio, and hopefully at some stage we'll get a proper NPL market in it, etc. The issue is not so much the NPLs as the performing loans. Because you can actually ask yourself questions about performing loans. Are they really performing? They have been mispriced in a low interest rate environment. So I think you should ask yourself about the banking model and about the sort of that issue as well within this whole discussion on whether level 2 or NPLs. So I think that's something to remember.
All right. Paulo.
Just, yes, on this issue, if I may comment on both Simon and Nicholas on the issue of the comparison. We know that it's a bit of a stretch, but we took NPLs to be the worst category in the balance sheet, and some of the indicators that come out of the paper are prima facie, similar. Does that prove something? No, it doesn't prove anything. The bells that I showed in the pictures do not prove anything. There is no issue. It is very difficult to disentangle, L3 type L2 from genuine L1, but the issue of saying that L2 and L3 are performing, whereas NPLs are non-performing, is sort of begs the question, because the issue is that there is a lot of opacity in there on a share of these assets, and you don't know exactly what's going on. Saying that NPLs do not yield a return, true, but the same goes for some of these assets. I haven't been able to put my hands on a series of returns of these assets. So the issue remains that they are opaque, that they are illiquid, and that if somebody forced banks to sell them, possibly high losses would materialize. Remember the issue that we brought out in the presentation, that fair value is not a liquidation value. It is a fair value, rightly so. I mean, that is the way it should be. But if you tackle NPLs, for instance, and you decide that those need to be disposed of at all costs, of course you're going to get a liquidation price. So the issue of some NPLs going to the market and fetching, say, 20 cents on the euro of gross book value relative to 40 cents on the euro of book or net book value doesn't imply that there is another provision.
Okay. Sorry, so unless there are other interventions from the panelists, I think we may need to bring this to close. Are there other questions from the audience? We could maybe take one more question. Francesco, yeah.
Just seen from outside, I mean, if a lot of L2 is really L1, why is it in L2 and not in L1? There should be an incentive to put in L1 as much as possible. So why is this not the case?
Okay, Nicholas.
Others here are more competent than I am, but I think the simple answer is that this is what the accounting standard says. There is a very strict definition of what you can put in L1, and it's not a definition which is based on really the level of certainty or uncertainty you have on the valuation. It's on the legal features of the asset and whether it's traded or not.
I think that was on the slide that was presented earlier.
Sorry, so I'm going to bring this
Just
to
a
close now.
Then it's not that they should be in L1. You don't agree with the definition of L1 and L2.
All right, gentlemen,
I think,
the accounting details we will need to
but
understand bilaterally.
accounting and economic analysis or prudential analysis are two different things. I think it's perfectly justified for the accounting standard to establish that boundary between a traded asset and an asset that is similar to a traded asset, and that's the difference between L1 and L2. It's a very good difference. So I would not be in favor of erasing that difference. Now, we can discuss whether for prudential reasons we should go into more granularity and having, level 1.5 and level 2.5, and in a way the discussion hinted at that direction. I think you have to understand how complicated it would be accounting-wise to have 5 levels instead of 3. 3 is already pretty difficult to manage. So I think here it is an age-old debate between accounting and prudential supervision. Accounting is not just done for prudential supervisors.
Okay, with that, let me bring this to a close. Thank our panelists, Paolo and the team from Bank of Italy for producing the paper, but also Tresina, Nicholas, Simon, Martin, who is left, and thanking you for participating and engaging in this debate. Thank you very much, and see you next time.